All right, welcome back to the fifth video in this series. And so the goal for this video is to explain the different types of future contracts and give price examples to show the risk you as a trader are willing to take. This should be a quick video because there's not much information. They're just kind of like examples with examples within them. So yeah. All right, so one of the most traded categories in the entire futures market is are the index future. And so these are contracts based on the value of a major stock index like the S&P 500, NASDAQ, and the Dow Jones Industrial Average. The most popular contract in this category is called the E-mini S&P 500, which has a ticker symbol of ES. And so when you trade the ES, you're trading the movement of the entire S&P 500 index, not just like a single stock, right? Other major contracts, like I mentioned, the Nasdaq and Dow Jones, and so the Nasdaq has the NQ, which is the E-mini, E-mini NQ, which is focused on the tech, which is really focused on tech heavy stocks, and then you got the Dow Jones, which is YM. And so these powerful tools, used by hedge funds, institutions, and retail traders to get exposure to the overall market really, really quick, right? They're great for speculating on market direction, hedging stock portfolios, and even quick day trade based on news or momentum. So to explain how pricing works, I'm gonna use the most popular ES as an example. So in the ES contract, a 1 point movement, which means $1 change, is equal to $50. So if the ES gains $1 and you bought in at one contract, you'll be up $50. If the S&P moves 10 points, this means obviously 10 times 50, which is $500 profit per contract, right? So if you buy in, let's say you're longing the stock, you're longing the ES futures, and it goes up 10 points, meaning it goes up $10, one contract, $500 in profit. These are really big numbers and the contracts are large, right? So to make it more accessible, the CME also introduced something called micro E-mini contracts, right? This works for all the index ones. So a micro E-mini contract, which have the same ticker symbol, but instead there's an M before the actual ticker symbol. So MES, MNQ, and MYM. What they are they're 1/10 of the size of the E-mini counterpart, right? So for instance, before we had 1 point, which is $50 on the ES. In this case, 1 point on the micro would be $5, which is 1/10 of 50, right? And this makes them perfect for new traders, smaller accounts, or those who are testing strategies with reduced risk, right? So if you're trying to test a strategy or you're not trying to risk as much money, you can just take a micro contract, which would help you still be in that position and make some profit. But if the position goes against you, you're not losing as much money. It's also really good for when you're doing prop firm trading and you can't lose that much money and you're still like want to make money. What you could do is you could get like 5 micro contracts, which is basically half the size of an NQ, or you could do like 3, which is basically a quarter. And yeah, and so all index futures trade nearly 24 hours a day, 5 days a week, with very tight spreads and deep liquidity, right? And so this makes them ideal for active traders. You can enter and exit positions quickly and often with minimal spillage. So to kind of summarize the index part, the index futures allow you to trade entire stock markets, not just individual names. And thanks to micro contracts, even small traders can participate with professional grade tools. Now, obviously, if you remember from last lesson, we talked about margins. A micro contract will have smaller margins than a mini contract because you're risking less. I'm just going to point that out there. They don't have the same margin requirements. Next, you have something called commodity futures. Now, if you don't know what commodities are, well, this is like oil, wheat, gas, etc. So this includes energy, gas, metal. Okay, I already said this. So the most commonly traded commodities, these are crude oil, which has a ticker symbol CL, gold, GC, corn, ZC, soybeans, ZS, and silver, SI. I didn't put silver on the thing, but yeah. These contracts are used by producers and consumers to hedge against price fluctuations. So as I mentioned this many times in the previous beginning lessons, for example, an airline might hedge jet fuel costs using oil futures. You could have a farmer who could lock in prices for corn, soybeans. You get it, right? But they're also heavily traded by speculators, right? This is because commodities are volatile and respond to global events, giving traders plenty of opportunity. Many day traders like to trade indexes, but one very big futures contract that is traded as well that is not an index is gold. If you go on YouTube and search up day trading, you will see a lot of people also trading the gold because there's a lot of news and all these stuff happening in the world, like tariffs and all that, oil prices. That all still has an effect on gold, right? If gold is technically considered a safe haven asset, right? It will always increase in value. Well, not always, but it's a safe asset. So people invest into gold when there is uncertainty in the global, like in the global market. So that's also why gold is traded a lot. So I actually want to look at gold and crude oil specifically to give you an example. We'll start with crude oil just because, actually no, we'll start with gold because we're already talking about it. So gold has a contract size of 100 troy ounces. And so a dollar move in gold will give you a $100 gain or loss depending if the market's like moving in the right direction or it's not. So if gold goes from $2,000 to $2,010, that's a $1,000 swing per contract. With crude oil, these contract sizes are 1,000 barrels, and a $1 move in oil is roughly is $1,000 profit or loss plus minus fees, obviously. And if oil moves from 85 to 86, and you're long one contract, well, you just made $1,000. And so these are large contracts, and that means large risk. But just like with the index futures, obviously there are micro contracts available in some markets like micro gold, which represents just 10 ounces instead of 100. That makes it easier for smaller accounts to get involved with lower exposure. Commodity futures are great for traders who want to capitalize on global market trends, right? You have trade assets impacted by weather, geopolitics, supply shocks, and diversify beyond stock indexes. So kind of just to summarize this, commodity futures let you trade real, tangible goods with global impact, but you must understand contract size and tick values to manage risk properly. The reason I'm giving you these examples is because if you want to start trading these, you should know how the price moves depending on how many contracts you buy in, well, how many contracts you risk. I'm not gonna say buy in. So you don't have to memorize these, but just you should understand or know the pricing on the futures you're trading. Another major group of future contract focuses on currencies. These are letting traders and businesses gain exposure to exchange rate movements. These are called currency futures, and they track the value of one currency against another. This could be like the euro against the US dollar or the Japanese yen against the dollar. Currency futures are standardized and traded on the CME, unlike spot forex, which is traded over the counter. This gives future traders the benefit of centralized pricing, regulated markets, and a clear margin and tick rule. So some of the most actively traded currency futures include 6E, which is the euro to the US dollar. You got 6J, which is Japanese yen to the dollar. You got 6B, British pound to the dollar, and you have DX. Well, this is a little different. This is the US dollar index. It's like an index within the currencies, and it's a basket of major currencies against the dollar. So it's a lot of currencies combined compared to the dollar. It's a little hard to explain. I'm not going to go into DX because it's a little more intense because different currencies against each other is already different. But then when you put them all together and you put it against the dollar, it's a whole other lesson. And so these contracts are large. So for instance, you have the 6E, which is the euro futures. It controls $125,000 euros worth of exposure. And so what that means is if the euro against the dollar moves by 0.01, which is 100 ticks, and you're holding 160 contract, that's a gain or loss of 1250 plus minus what's it called, fees. And so each tick, if you divide that, that's going to be $6.25. These contracts are popular for hedging currency exposures if your business is earning in foreign countries, speculating on global macro trends, so interest rate decision or economic data releases, and even traders who prefer a regulated alternative to forex without dealing with over-the-counter brokers. Future traders who are bearish on the US dollar might go long the euro or pound futures, right? Those expecting strength in the USD might short those contracts or go long DX, the dollar index future. And just like the markets, the CME offers microcurrency contracts like M6E for smaller traders, usually 1/10 of the size, making it easier to manage risk and capital. And so for the last one, we have the interest rate futures. These are contracts based on either U.S. Treasury securities or short-term bench rate marks. If you know what Treasury securities are, I talk about this, I'm pretty sure, in the bond lesson. So you could go back and check it out. So these contracts allow traders, banks, and asset managers to bet on or hedge against changes in interest rates, including rate cuts or hikes by the Federal Reserve. The most common interest rate futures include ZN, which is a 10-year Treasury note. You got ZB, which is a 30-year Treasury bond. You have ZF, which is a 5-year note. You have GE or SR3, which is futures tied to short-term interest rates like the SOFR, which is secured overnight financing rate, and which is also which has been replaced by LIBOR. But you guys don't really need to know that. It's okay. So there are some things that are unique. So the price of the futures moves inversely to interest rates, right? If rates go down, bond futures go up. I'm not going to explain it right now. If you want to understand this, go back to the bond lesson. There's a whole lesson on reversals and the correlation between the two. And obviously, if rates go up, future prices go down. So for example, if you believe the Fed will cut interest rates, you could go long on, let's say, ZN, the 10-year futures, expecting bond prices to rise. If you think rates will rise, you might short ZB or ZN. These contracts have unique pricing systems. They're quoted in fractions. For example, ZN is priced 1/32, so 1 over 32, and 1 over 64th of a point. So a tick in ZN is 1/64th of 1 point, which equals 15,625 per contract. These contracts are heavily used by hedge funds and macro traders speculating on rate direction, banks managing interest rate risks on loan and deposits, and portfolio managers adjusting bond duration and risk exposure. Interest rates futures are less common among beginner traders, but they're essential to understand the broader forces that move the market, especially during Fed announcements, recession fears, and even inflation reports. I hope this video helps you. This is like these are honestly the only futures you really need to know about and perfect, especially the index and commodities. You could touch on currencies, but I'd say index and commodities are very, very similar. But yeah, I hope this video is helpful, and there'll be a new video coming out soon as well. Thanks.